Hi, this is Harsha Venkatesh from Dwaith Funds. We'll talk about a newsletter I recently wrote. This is about the recent war between US and Iran and how that has impacted the stock markets. You see, traditionally in India, the stock market gets affected by any world event. So if US sneezes, India catches cold. If there is something happening somewhere in Russia, Ukraine, India will get affected. So that's traditionally been the case. But is that a permanent thing? So will something happening in Middle East affect Indian markets to such a large extent that it goes down 10, 20, 30% down? Is that the question we need to be worried about? The answer, of course, is no, and I'll tell you why it is. When we had the Iraq war in 1990, the highest correction in Indian market was around 14%. This was in 1990. When Kargil war happened, the correction was 11%. So it fell down by 11%. When the WTC attack happened in 2001, it was 18% correction, 2001, and it came back. So the 6 months return after the WTC attack was 45%, positive 45%. When the Mumbai attack happened in 2008, it had corrected by around 3%, not too much actually. Pulwama attack, it was minus 7%. Ukraine war, when it happened in 2022, the highest drawdown was around 11%. The Iran-Israel as well as the US war is still ongoing. We don't know what would be the lowest point. We have already seen the markets dip. So around 3 to 5% dip has been there. So traditionally, if I look at the market volatility, there is always going to be a dip whenever there is a war. That's a given. And how does India get impacted by the Iran war? Of course, the Strait of Hormuz is super important because a lot of the Middle East oil comes through the Strait of Hormuz. India also buys oil from Middle Eastern nations, and we are impacted. What is the key here in the Iran war? Will Trump be happy by killing the senior Khamenei and having the junior Khamenei as the head of the nation? Would that be okay for Trump? So will sanity prevail? That is the key question. Or will US and Israel say that we are not happy with what is happening in Iran? I'm going to send the ground troops like it happened in Afghanistan. So what happened in Afghanistan? They said we want to replace Taliban. They sent the ground troops. They occupied Afghanistan. After 20 years, as soon as US left, immediately Taliban went and reoccupied. That is what happened. They replaced Taliban with an intermission of 20 years. Will something like that happen in Iran is the question. Iran is not Afghanistan. So Iran is like, I was looking at the size of Iran. Iran is like half of India. The whole of South India and Gujarat, maybe that's the size of Iran. And if you are looking at going there with troops trying to occupy, it's going to be one hell of a thing. It's not very easy. So with that being the case, let's say Iran is not going to get occupied by the US, in which case all of this is a temporary blip. Let's put it that way. If that is the case, what matters in the long term? In the long term, for stocks, the only thing that matters is how is the economy performing. And within the economy, how is the company which you are looking at performing? What do I mean by how is it performing? How are the earnings growth prospects of the company? So if today, let's say a company is earning 10 rupees, next year will it earn 12 rupees? Will it earn 15 rupees? Will it earn 20 rupees? Will the earnings go up by 20%, 50%, 100%? That determines how the company will do. And with respect to how the valuation is, so if the company is earning 10 rupees, let's say the value of the company, the market cap of the company is 100 rupees. So then what is the earnings multiple? Price to earnings. Price to earnings is 10x. If the company is earning 5 rupees, and let's say the market cap of the company is 100, then it is having a price to earnings of 20 times, because 100 divided by 5 is 20. So let's say the company is earning only 5 rupees while the market cap is 100. So the yield on that is nothing but 5 divided by 100, which is 5%. the earnings yield is 5%. So it's as simple as that. You have to get a company at a lower valuation. Of course, the price to earnings has to be low. It has to have good growth prospects. And then at the end of the day, there are certain parameters on which a company depends on how the perception of the market is. So all of that would depend on a few things. One is, how are the interest rate environment? What do I mean by interest rates? If the interest rate environment is very low, of course the market will give a higher valuation for the company because you are discounting at a lower interest rate. So the value of the company would be much higher. Number two is the factor of inflation. See, inflation is something which will eat away your money, my money, everybody's money, because what is today 10 rupees, a year down the line, that same value would no longer be 10 rupees. You are not going to get a simple chocolate for 10 rupees, it will be 12 rupees. So there is an inflation aspect to it. So as long as the inflation is kept at a lower number, it's always better for everyone in the market and everyone out there. The third one is liquidity. What do I mean by liquidity? Liquidity is what determines whether you are able to buy something or sell something in volumes in the market. So if there is a panic type situation, typically what happens is liquidity goes away. So if you want to sell something in the bulk in market, you cannot buy or you cannot sell that easily because there would not be any counterparty who will buy that much in bulk. So that determines the liquidity in the market. So if there is a lot of panic, liquidity is the first thing which goes away. What I am trying to allude is, as long as you are invested in high quality companies with good growth prospects, which you have bought at reasonable prices, I think there is absolutely no reason to panic. Some of my investors and others have also asked, how do you see the market? What is happening in the market? See, at the end of the day, as long as there is sanity prevailing, there is no reason that our country, which is a very small country in the scheme of things, I think we only have one way, and that's on the upward trajectory. So I think as long as that is intact, I don't think there is a worry for all of us. So all I would say is, do not panic, keep investing, and I would say just look at the long term. Don't look at 3 months, 6 months. Look at 3 years, 5 years, 6 years. That's the way to look at it. Thank you.